then it's also important that you are able to discuss factors that should be considered when deciding on the form of finance. So this would be a discussion type question. Now what I want you to do, guys, is you are going to study all of the headings that I've provided you with. So the first heading is cost considerations. We then have issue or transaction costs. We then have impact on cash flow, matching or suitability, associated constraints, risk profile or capital structure, control, interest rates, and finally, you are going to conclude. Let's just have a look at these exam technique points over here. So like I said, you are going to study the headings that I've provided you with. And those headings should be used as a trigger for your discussion. So based on the information provided in the scenario, you are going to go through each of those headings and decide whether there's something you can discuss under each of those headings. So is there anything to discuss for cost considerations? Is there anything to discuss under interest rates? Is there anything to discuss under control, etc.? Study the headings so that you can use them as a trigger so that you can consider whether you need to discuss anything under that heading. But it's important to note that your discussion must be specific to the financing options that are provided in the question. So you can't just study all of the information that I've included under each of the headings and just write down a memory dump of everything that you've studied. That won't work. I've provided you with the headings and the information under the headings so that you can consider whether that information is relevant to your particular scenario that you've been provided with. But this can't be a memory dump. Marks will not be awarded for general points. That's very important. So what are you going to do if there are headings that are not applicable? So you go through the list of headings, you discuss everything that's applicable based on what you've been provided with in the scenario. If there's any headings that are not applicable, you should just exclude them from your solution. So if there's nothing to discuss under the heading of control, then just leave that heading out. So guys, I'm giving you the headings just to help you remember the potential things that should be discussed. But it also does not matter if you discuss something under a different heading. So maybe you get a bit confused and instead of discussing something under interest rates, you discuss it under the impact on cash flow. That doesn't matter, all right? So in this section, the headings are purely provided as a guide so that you can consider whether you need to discuss something under that heading. So it's like a prompt or a trigger for you. Okay, but you'll still be awarded the mark even if you include the point under a different heading. Even if you don't write down the headings, you will still be awarded the mark, all right? And then please make sure also that you always have a conclusion. Let's go back to the information provided under each of the headings so that you can see the potential things that should be discussed. All right, so what's going to happen, guys, is they are going to provide you with different forms of finance that are available to a company, so different financing options. There might be a share issue, there might be a loan, there might be a lease, there might be convertible debentures or preference shares, redeemable debentures or preference shares, etc. They will give you different types of finance that are available to the company. You will then discuss those types of finance under these headings. Now guys, obviously if one of the options is not a convertible preference share, then you can't discuss things that are relevant to convertible preference shares. So you can only discuss things that are relevant to the information provided in the scenario, okay, or relevant to the financing options that you have been provided with. So under cost considerations, the types of things that you can discuss is debt is normally cheaper than equity. Why is debt cheaper than equity? Because the providers of debt capital are prepared to accept a lower return because they are exposed to less risk. Remember the relationship between risk and return. If you are exposed to less risk, you'll be prepared to accept a lower return. So why are the providers of debt capital exposed to less risk? Because interest and capital payments are agreed upon in advance and must be paid regardless of financial performance. So even if the company has a bad year, they still need to make those payments. On the other hand, if we look at equity, With equity, if the company has a bad year, they don't have to pay dividends. So equity providers are exposed to higher risk, and because they are exposed to higher risk, they are going to want a higher return. With debt providers, they are exposed to lower risk, so they will accept a lower return. In addition to that, in most instances, debt is secured against assets. So if the company does default, at least the debt provider can repossess the assets in order to recover any money that they might have lost. And also the providers of debt capital rank above shareholders in the case of liquidation. So when a company is liquidated, everybody else gets their money back first and ordinary shareholders rank last. So if there's no money left, they obviously lose everything. They stand the most to lose. So once again, because equity providers or ordinary shareholders are exposed to higher risk, they want a higher return. On the other hand, debt providers are exposed to less risk, they will accept a lower return. In addition to that, we also know that interest is tax deductible, which further reduces the cost of debt, whereas dividends on ordinary and preference shares are not tax deductible. Then, if you are comparing two different types of debt finance, a lender will normally charge a higher rate of interest on longer term debt, and that is because shorter payback periods are less risky for the lender. So, if the bank is giving a loan, a 2-year loan is a lot less risky than a 20-year loan. A lot more can go wrong in the next 20 years, which will affect the ability of the company to repay the debt, as opposed to a 2-year loan. So because longer term debt is more risky, they're going to charge higher interest rates. Shorter term debt, less risky, they'll be prepared to charge lower interest rates. However, you do sometimes see longer term debt with lower interest rates. And the reason for that is if security is provided on longer term debt, the risk to the lender is obviously then reduced, and they will then charge a lower rate of interest. Then with convertible debt or convertible preference shares, investors will usually be prepared to accept a lower return initially, so a lower dividend or a lower interest rate initially, because in the future, when the convertible debt or the convertible preference shares actually convert into equity, they will then be able to participate in the future growth of the share price. Then the next heading that you need to consider is issue or transaction costs. So guys, whenever a company raises new debt finance, so they enter into a loan agreement, they issue debentures, whatever they're looking at, or if they issue new shares, there will be issue or transaction costs. And debt normally has lower issue costs than equity. It's important to note if a company is using equity finance, either they can issue new shares to raise equity finance, or if they have enough reserves and enough cash available within the company, they can use the money that's already in the company and they need to issue any new shares. So obviously, there are no issue costs involved if a company uses their own existing funds in the form of reserves. So this would be applicable, for example, if we have a company, over the years they've had very significant profits, they haven't paid very high dividends, so they've kept money in the company, and they can then use that money within the company to finance expansion, and they won't need to then issue new shares. Okay, so that's where retained earnings is used if there is cash available. Then it's also important to note that a rights issue is cheaper than an offer for sale to the general public. So guys, a rights issue is where the company sells shares to existing shareholders only. So the general public can't buy shares, only existing shareholders can buy shares. And because they are selling shares to existing shareholders only, they won't need a prospectus, and the marketing and admin costs will be lower. So as a result of this, a rights issue is cheaper than an offer for sale to the general public. Now guys, I've included a lecture example on how a rights issue works. I've included this for completeness sake, so if you want to see the calculations behind a rights issue, please go and have a look at this lecture example. I'm not going to go through it with you because it's very seldom examined. Then lastly, under the heading issue or transaction costs, please note that issue costs are only paid once in respect of convertible debt or convertible preference shares. So when you issue the convertible debt or the convertible preference shares for the first time, then the company will incur issue costs, but when they convert into equity, they won't incur those costs again. So they only incur the issue costs once. Then under the heading Impact on Cash Flow, if a company raises debt finance, interest and capital repayments are agreed upon in advance and must be paid regardless of financial performance. So even if the company has a bad year, they still need to make those payments. And that could obviously have a negative impact on their cash flows and on liquidity. On the other hand, dividends on ordinary and preference shares do not need to be paid if profits are poor. Then guys, regarding preference shares, it's important for you to understand that preference dividends must be paid before ordinary dividends. So a company can't pay their ordinary shareholders a dividend if they haven't yet paid the preference dividend. The preference dividend needs to be paid first. Then, if preference shares are cumulative and there is no cash available in one specific year to actually pay that dividend, then it needs to be caught up in subsequent years. So if it's a cumulative preference share, that means dividends must be paid. However, if the company doesn't have the cash available this year, they don't have to pay it this year, but next year they're going to have to catch it up. So they're going to have a year where they're going to pay more than one dividend because it does need to be caught up in subsequent years. Then where we have participating preference shares, they receive ordinary dividends over and above their preference dividend. So they get the preference dividend, and on top of that, they also share in the ordinary dividends. So just make sure that you understand the relationship there, please. Then, where we have convertible debt or preference shares, and they convert into equity, that does not provide extra funds for the company. So when the company first issues the convertible debt or the convertible preference shares, that will result in a cash inflow to the company. However, when they convert into ordinary shares, that doesn't raise any new finance for the company. So there's no further cash inflow. They only get the cash inflow once when they first issue the convertible debt or preference shares. Then the next heading that we need to look at is matching or suitability. And the logic that we follow is the useful life of the asset and the payback period of the finance should match. So in other words, guys, if the company has an asset with a useful life of 5 years, they should then try and find finance which is going to be repayable over a 5-year period. You match those two. And the logic behind matching them is if the company is going to be able to use this asset for a period of 5 years, they are going to generate income from this asset over a 5-year period. And they can then use the income that they make from this asset in order to pay the finance. All right, so that's what we're trying to do here. This is so that the cash inflows that are generated from using the asset or from the investment can be used to settle the financing cash outflows. Guys, you don't want a situation where you have an asset that has a useful life of 10 years, but you get finance which has to be repaid within 2 years, because there's a chance that you won't have raised enough money yet from using that asset to pay back the finance. So that's a situation that you definitely don't want. You want the useful life of the asset and the payback period of the finance to match so that you can use the money that you generate from that asset in order to meet the financing commitments. Then the next heading that we are going to look at is associated constraints. Now, when it comes to debt finance, companies might be required to provide security or give collateral. So that is where assets are pledged as security. So you have to give an asset as security. Now, guys, there's a bit of misunderstanding here, so I just want to make sure you understand. If a company has to give a machine, for example, as security, they still have that machine on their premises. They still use that machine. They don't actually give the machine to the finance provider. They keep the machine. However, if it's given as security, the only thing that happens is if the company defaults and they don't meet their commitments in terms of the finance agreement, then the finance provider will come and they will take that asset or that machine and they will recover what they've lost by selling that machine. So please note, some students seem to be a little bit confused and they think where security is given, the actual asset is given to the finance provider. It is not given to the finance provider. The finance provider only comes and takes the asset in the case of default. But one of the problems of security is it will restrict the company's ability to borrow funds in the future, because if you've already given all of your assets as security, you won't have anything else to give as security for future finance. Then in addition to that, debt might come with covenants. Now, a debt covenant means there might just be requirements to maintain certain ratios. So they might have to meet certain profitability ratios, for example. Or debt covenants can also prohibit certain actions, such as the payment of dividends or the sale of certain assets. So guys, remember, all of this is to protect the debt provider, or the finance provider. So if a bank has given a company a loan and they want protection, they might then want, obviously, security or collateral, so that if the company defaults, they can repossess that asset and they can recover what they've lost. And they might also have debt covenants in place. So they might say to the company, while this loan is outstanding, you need to achieve certain ratios. You must have a certain interest cover. You must meet certain profitability ratios. During this period, you can't pay any dividends, and you also can't sell assets. So the reason why they don't want you to sell assets is obviously if you default, they won't be able to repossess those assets to recover their losses. So those are sometimes some constraints that are associated to debt finance. When it comes to equity finance or issuing new shares, you obviously need to make sure that there's sufficient authorized share capital available. The company needs to make sure that they comply with their memorandum of incorporation in terms of any necessary shareholder approvals. And in addition to that, if a company is listed, they obviously need to comply with the stringent listing requirements. Then under the heading risk profile or capital structure, we know that whenever a company raises new finance, they need to move towards their target capital structure. So you should always compare the current capital structure to their target and make sure that they move closer towards their target capital structure. In addition to that, if you have been provided with industry or competitor information, then you should also compare the company's current capital structure to the industry or competitor information. And if when you make these comparisons, so when comparing the current capital structure to the target and the current capital structure to industry or competitor information, if you find that the company's debt levels are too high, so they're very highly geared, they have a lot of debt in their capital structure, then they may have no alternative but to use equity finance, because using debt finance will further increase their gearing and financial risk. And the problem with this is if cash flows deteriorate unexpectedly or if interest rates increase, they may have difficulty in meeting the capital and interest payments. And because of this increased financial risk, shareholders are going to be exposed to more risk. And if shareholders are exposed to more risk, they are going to want a higher return on their investment, and that is going to cause the cost of equity to increase. In addition to that, if companies have a lot of debt in their capital structure, they are highly geared, these high-risk companies also attract higher borrowing costs, because if you're more risky, banks that provide you with loans are going to charge higher interest rates, and that also causes the cost of debt to increase. So companies can't have too much debt in their capital structure. On the other hand, if you compare the company's current capital structure to their target, and you also compare it to industry or competitor information, and you see that debt levels are very low, this could then provide the company with an opportunity to introduce more debt into their capital structure. And the advantage of this is we know debt is cheaper than equity. So if they introduce more debt into their capital structure, that will cause the WACC, or the weighted average cost of capital, to decrease. It's important to note if you are calculating gearing, so if you are trying to determine the amount of debt a company has in their capital structure, redeemable preference shares are going to be classified or treated as debt. Because guys, redeemable preference shares are exactly like debt. The company issues the preference shares, they pay dividends on the preference shares, and eventually those preference shareholders are repaid. It's exactly the same as debt. So redeemable preference shares should be treated as debt if we are trying to calculate gearing. On the other hand, the following forms of finance will not increase a company's gearing. So if you are trying to calculate the amount of debt that a company has in their capital structure, the following forms of finance will not be taken into account. Non-redeemable preference shares, Remember, a non-redeemable preference share is a preference share in perpetuity forever. So it's similar to equity because it never needs to be repaid. So it won't affect the company's gearing. Convertible debt or convertible preference shares, because in the long term they'll convert into equity. So they're treated as equity and not debt. And a bank overdraft is not included in your gearing calculations, guys, because a bank overdraft is short-term in nature. And when calculating gearing, we only look at long-term or permanent sources of capital. So non-redeemable preference shares will be treated as equity. Convertibles will be treated as equity. And the bank overdraft is not included because it is a form of short-term finance and not long-term finance. So these will not impact on the gearing of the company. On the other hand, redeemable preference shares will be treated as debt, and they will impact on gearing. Then under the heading control, obviously if a company issues new shares, that will impact on control and will dilute earnings per share and other key indicators. This will not happen if the company uses their own existing funds in the form of reserves. So we saw this previously. If a company is looking at equity finance, either they can issue new shares, or if they have been very profitable in the past and they haven't paid very high dividends and they've got enough cash available within the business, they can obviously finance it using existing reserves or existing cash within the business. So they can use retained earnings if cash is available. And obviously if they do that, control will not be affected. However, if new shares are issued, control will be affected. In terms of a rights issue to existing shareholders, control will be affected if all shareholders do not exercise their rights. So guys, how a rights issue usually works is the company will say you can buy 1 share for every 10 shares that you currently hold. Now let's say, for example, some of the shareholders exercise their rights and they buy the shares and the others don't. Obviously the ones who don't exercise the rights and buy those shares, there will be a dilution in control. Their percentage shareholding will deteriorate, their earnings per share will deteriorate, etc., because now the other shareholders hold more shares in comparison to them. It's important to note that if a company issues preference shares or debt, that will obviously not have any impact on the control structure of the company. And in addition to that, when convertible debt or preference shares convert in the future, when they convert into equity in the future, control will obviously also be affected. Then under the heading interest rates, interest on debt finance can either be charged at a variable rate linked to the prime lending rate, for example, or at a fixed rate. Now, if interest is charged at a variable rate, that is going to expose the company to interest rate risk, because there's a risk that interest rates might increase. And if interest rates increase, obviously the company's interest expense will increase, and that could have a negative impact on their cash flow position. However, please note this risk can be hedged, so the company can hedge interest rate risk by entering into an interest rate swap agreement, for example. Now, the benefit of a fixed rate of interest is this will provide the company with more certainty relating to their interest expense or their cash flows. So they'll be able to budget more accurately because every year they know exactly what their interest expense is going to be. So it doesn't matter if the prime lending rate changes, that won't have any impact on the company if their interest is charged at a fixed rate. If interest rates are expected to drop, then a variable rate is preferable. So obviously, if the prime lending rate drops and you enter into a loan agreement with a variable rate, your interest expense will also drop. So if interest rates are expected to drop, a variable rate is preferable. On the other hand, if interest rates are expected to increase, then a fixed rate is preferable, because when the prime lending rate increases, then that won't have any impact on your interest expense because it's fixed every single year. However, it is important to note that fixed rates are traditionally higher than variable rates. The bank is going to charge a higher rate because they are the ones taking the risk. If you pay a fixed rate and interest rates in the country all of a sudden double, you don't face any risk. You're still paying exactly the same interest rate. The bank is taking the risk. So because the bank is taking the risk, they are going to charge a higher rate of interest. And it's important to note that in South Africa, variable rates are a lot more common. Then finally, guys, under the last heading, you are going to conclude. So please note over here, there's no right or wrong answer. Based on what you discussed under all of the other previous headings, conclude on what you believe the best form of finance will be based on the information provided in the question. So that would be a consequential mark. All right, guys, those are all of the headings that you need to consider. Please go and look at the lecture examples for this section. Make sure that you are able to actually apply this to a question. So it's not a memory dump. Don't study everything off by heart. Study the headings, use them as a trigger, and then based on the information provided in the question, slot everything under those headings. Please make sure that you practice that on your own. All right, guys, that then brings us to the end of this lecture. Thank you very much.